Buenas tardes a todos. Good evening. Thank you, Mahmood, Eric, and Carlos for being here. It's an honor to have you here and to host this very interesting panel. I'm sure that the audience here and all the audience that we have through digital channels will be very interested in continue the conversation around global economic outlook. David and Leo already touched some of the most interesting topics around that, and I'm sure that we will as well contribute with a very interesting conversation. We plan on talking about consumer strength, the surprise of the consumer strength, mainly in the US, the direction of the rates, and what we're expecting in terms of Fed decisions. Are we going to have a soft landing in the US or not? The China slowdown and the impact in global economy, and obviously we'll cover a little bit about geopolitical implication of conflicts, Russia and Ukraine, the USA and China trade war, and most recently the very unfortunate events and the tension in the Middle East. So let me start with you, Mahmood, if I may. We would love to listen to your expectations regarding economic growth, inflation, and interest rates in general, globally, please.
Okay. Thank you very much, and thank you for the invitation. It's a pleasure to be here. Let me give you a general overview of how I see the global picture going forward. I think growth is slowing for a number of reasons. Thank you, Eric. Growth is slowing for a number of reasons. We have a global monetary tightening that has been underway for a while. I'll talk later about where we are exactly on that tightening, but I expect that we are very close to at peak rates, but a lot of lagged effects of the monetary tightening that are already that are still to play through, and that's really important for how we think about the global outlook. Secondly, through the shocks that we have lived through, the pandemic, the war, etc., some of the policy responses, both in the US and Europe, are now beginning to fade, especially the fiscal response. The policy responses that tried to protect jobs and employment, disposable incomes, those are now subsiding. In addition, we have a global trade environment which is showing signs of fragmentation. Okay? So global trade, the outlook for global trade is fairly subdued. So to answer your question, I think the optimistic view among forecasters would be global growth at 3% next year. We think it's probably a little bit less than that. That's point one. You asked about interest rates. I think interest rates have peaked. I mean, I'm being very general here, obviously not all specific economies. There's a little bit of risk coming from the current situation in the Middle East, where the risk is that we get some spike in oil prices, and that can give us headline inflation being higher for longer. I'm relatively sanguine about inflation coming down, but with the proviso that there is a little bit of risk, which means that monetary policy may need to be restrictive for a little bit longer than necessary if we do get this headline inflation, and that's a risk. It's not our baseline. So in summary, I'd say, the optimistic view would be a global soft landing, but with lots of risks, and we can talk about that later.
Thank you, Mahmood. I'll go with you, Eric, right now. Having in consideration what Mahmood just mentioned, what do you think are the main drivers of economic and financial trends that global managers and investors in general should really focus on in the following 12, 18 months?
Well, this, I think, is one of the biggest changes that we have seen in many decades, was getting off of zero rates. This is not true so much in countries like Mexico that never had zero rates. Here in Mexico, rates got down to maybe 3 or 4%. But in the United States, in Canada, in Australia, New Zealand, Japan, Western Europe, there are a whole generation of investment managers who've never had to truly consider the opportunity cost of capital. They just assumed that interest rates were zero and that any investment they make is benchmarked versus zero. Now they have to think to themselves, well, I can get 5% or more by investing in US 3-month T-bills. Why should I take the additional risk of therefore investing in the stock market or investing in real estate or investing in green energy or whatever infrastructure or other project they might be invested in? So I think the fact of much, much higher global interest rates is going to have very, very profound consequences for the global markets. And the United States has just been through the biggest rate hike cycle since 1981. The rate hike cycle that preceded the global financial crisis was a mere 425 basis points of tightening. The Fed has done that plus an additional 100 basis points. And we've had tremendous interest rate increases throughout Europe, all of Latin America, and essentially all but 2 economies in the world. Only Japan and China have not raised interest rates. Secondly, you have asset valuations that became very inflated in an environment of extremely low interest rates. When bond yields were at, say, 2% at the 30-year bond, it made it very attractive to invest in equities or really anything that could potentially produce a return greater than just a couple of percent. Now the threshold for taking active risk into markets is much, much higher. And you have many, many highly valued assets. You have highly valued real estate, particularly commercial real estate, I think is very, very vulnerable to very, very severe declines in prices. People are not going back to offices. People are in the same rate as they were before the pandemic. So you have much higher vacancy rates in office buildings. People have learned that they can do their shopping online, so they don't need as many shopping malls or shopping centers. This entire area of the economy is, I think, very, very highly leveraged and potentially very dangerous. And I think that there are certain other places in the world that have very high even residential real estate prices. For example, in the United States, it now costs 50% more to buy a home than to rent. You also have potential real estate bubbles in many other places in Canada, Australia, Sweden, parts of France and Germany. So I think there's a lot of risk built up in the system.
Thank you, Eric. Everything is connected, Carlos, and if we talk only about one certain region or one certain country, it's difficult to understand the rest of the implications. What do you think it's the perspectives of the evolution of large economies such as the US with a soft landing or not, China downturn, etc., in terms of how the rates are going to continue behaving in the following months? And specifically, how this will affect the affecting economies and markets, specifically such as Mexico?
Well, first of all, thank you very much for the invitation to participate here in this important meeting, or at least big meeting. And I think I agree with those that say that there is the probability of soft landing in the big economies is higher and higher every day, right? I remember if this meeting had taken place 9 months ago, everyone would have been saying that the hard landing was more probable and the soft landing was really not something that many people expected. Now, in my view, the situation for the emerging economies, and especially the bigger ones, and especially the ones in Latin America, like Brazil and Mexico, follows this track, more or less the same track, right? I think we are going to have a sort of a soft landing, but with some peculiarities in the case of Mexico, for example, in which, in my view, there is a lack of coordination of monetary policy and fiscal policy, similar to the US probably, right? In which fiscal policy has been very expansive, as opposed to what people, what the official speech sustains. That there has been no indebtedness and so on, which is not true. But the fiscal policy has been expanding and will be very expansionary next year, extremely. I mean, debt alone in 2024, according to the government plans, will increase by something like 13%. And although the ratio of debt to GDP is not extremely high, the indebtedness has been very high, right? Because in my view, inflation hides a little bit the information given by this ratio. For example, debt in Mexico will be, according to government plans, 60% higher in 2024 than what it was in 2018. So in my view, that's very expansionary. And monetary policy has been very contractive. And I think that is going to prolong the recovery, at least in some areas, in some segments of the economy, like the SMEs, for example, the small and medium-sized enterprises, which whose the cost of credit that they face is extremely high, right? Because of the tightening and because of the
level of rates.
High interest rates, extremely high. Bigger enterprises in Mexico have less trouble because they usually keep more money in their treasuries, and they rely less on financing from banks. You know? So that's a little bit the way we see it. In emerging economies in this region of the world, the IMF predicts that they will, or the prediction is that the rate of growth will be something like 2.3%, right? Which is lower than the world prediction, the prediction for the world. And it's only a little bit above advanced economies. So I think it's very disappointing what the outlook today, no? At least the economy that I know better, a little bit better, Mexican economy, the institutional decay has been very important. And the public finances, although they look well in a photograph, the dynamics are not very optimistic, right? Because, you know, there are so many pressures mounting up every day, and the next government, which will take place next year, of course, will have a serious fiscal situation to face.
Thank you, Carlos, and I'll go back to you later on to go in more detail on this. I would go back to MAHMOOD and ERIK, and we have mentioned already the probability of a soft landing or not. But there are still some voices in the market that say that the soft landing, even if it's with the higher probability, there are other scenarios. And in those scenarios, different things can happen. So I would like to ask you how the financial markets would react in case the not soft landing scenario materializes. What's your view, MAHMOOD?
Okay. Let me start by two observations.
Mike.
One is, thank you, Eric. One is the question we all need to keep in mind where real interest rates are in the US. We all know, and we all have caught up with, yes, the US economy has been pretty resilient, and we've all gone through various factors and reasons. Going forward, is the US economy resilient to 2.5% real interest rates? That's the question that I think is really important, okay? Very briefly, I think there is something positive about investment in the US because of IRA, the CHIPS Act, and so on. We've seen strong announcements. But one should never forget that it's still the case 70% of US GDP is consumption. We know the borrowing costs for consumers and for firms in the US economy are very, very high. So the question is, how long can the US economy be resilient? I'm a little skeptical about that it can be resilient. Now, financial market corrections, how long will real interest rates stay at 2.5%? That's an open question. Secondly, in my view, whether we have a soft landing, which is our current baseline scenario, which is sort of a mild recession in the first half of next year, or we have a hard landing, will really depend on two things. One is how sticky inflation is from here. If inflation remains a little sticky and is slow coming down, then the Fed will be in a very difficult position, okay, in order to meet its mandate, etc., etc. Then we are in the higher for longer narrative that we've all heard. If inflation falls, then we don't need to be in such a restrictive period of monetary policy for too long, okay? So that's the distinction between soft and hard landing. Now, of course, I mentioned earlier there are some risks if oil prices spike and so on, and these are all things we will be watching carefully, and it's difficult to tell. Our global growth outlook that I talked about earlier suggests to me that an oil price shock would be supply-driven because of various events. It would not come from demand, okay? So by and large, it would come from supply, and these are difficult risks too. I think to answer your question, how will financial markets react? I think duration will be a very attractive proposition. Bond yields will fall because I fundamentally believe that if I go back to pre-pandemic and ask myself the question, has the US economy fundamentally changed to now be able to withstand 2% plus real interest rates? And I find it difficult to come up with a convincing answer. Thanks.
Thank you. ERIK.
Yeah, I mean, I would add to that just go back and look at history. So we had a recession in the United States in 2001. It was a very, very mild recession. It was a strange recession. Business investment collapsed, but consumer spending was actually okay. Housing did okay. What happened to the stock market? Well, the S&P fell 50% and the NASDAQ declined by 85%. It was not a very happy period for people invested in the US stock market. If you go back to 2008, the stock market peaked in October 2007. It hit bottom in March 2009. It fell 60% on the S&P 500. If you look back to the beginning of COVID, the market dropped 35%. So far, we actually had a bear market last year. Then we had an 8-stock bull market, where Tesla, Amazon, Google, a tiny number of stocks, Microsoft were going up. That seems to have run out of steam because the equity investors now realize, okay, well, you can get a pretty decent return without taking any risk. You get 5.3% in 3-month T-bills. Why would you invest in equities? Why would you take the additional risk? So I think that given the market's valuation levels in the US, there's a very real possibility that we do see a more serious decline in equity prices if we have an economic downturn, which of course we don't know for certain. But I would also point out just one other thing. The Federal Reserve in 2006 stopped hiking rates in June 2006. The economy did very well for the next 6 months of 2006, and it did just fine for the first 6 months of 2007. The stock market did not peak until October 2007, and according to the National Bureau of Economic Research, the recession that we now call the global financial crisis did not technically begin until December 2007, 17 months after the Fed's last rate hike. So, look, the Fed stopped hiking rates maybe in July. We don't know that for sure, but probably stopped hiking in July. It's totally normal the economy is still growing. There are what the Fed calls long and variable lags between when they change monetary policy and when the effects are felt on the economy. And right now we are living in that lag period. The Fed stopped raising rates in May 2000. Recession in 2001 began 10 months later. The Fed stopped raising rates in February 1989. A recession began 17 months later in June 1990. It's totally normal the economies around the world are still growing even after these massive rate hikes. That does not mean that the growth will continue.
And that takes me to the next question. And Mahmood, you were mentioning about sticky inflation, and obviously inflation is one of the most important concerns in economic environment. And I'll go to you, Carlos and Eric. Even though we have seen a downward trend in inflation, mild still, but something that it's going down, do you think that if that is, it continues for a long period, as you were mentioning earlier, Carlos, is there space for another cycle of rate hikes? I think market has already discounted maybe one additional hike in Fed funds, but what's your view? Do you think if inflation continues with the trend, another hike cycle will
I wouldn't dare doing any forecasting attempt. I think there is no much room, in my view, from the real economy point of view. Mahmoud was talking about the ability of the American economy to function with a high real interest rate. The real interest rate in Mexico, ex ante, taking the central bank rate, is about 7%. So that's, in my view, that's very high, okay? It's leaving aside, again, as I was trying to explain, a big segment of the economy, which are the small and medium-sized enterprises, right? So that's very important already. Now, in general, the emerging world, the emerging markets, have been less successful to reduce inflation than the advanced economies. You know, the reduction of inflation has been slower, and Mexico is more or less in that trend. So we're no different from other countries. Although monetary policy has been very aggressive, as I was trying to explain. And it has been more sticky, but it's very high, the interest rate. So I think that if this takes long to reduce, if there is a long time before reduction of the interest rates, the economy will not be able to grow as much as we have seen recently. Let's put it that way, no? That's in the case of Mexico, and it seems to be the case in Brazil too, which is the other big economy.
Same, yeah. Eric, any views on this?
Well, you know, I think that the scale of the rate hikes around the world is just truly, truly astonishing, and that if I had to guess how things are most likely to turn out, I would guess that the economy will continue to grow in the U.S. for some period of time, you know, another 6-9 months before the chickens really come home to roost. And that when push comes to shove, you have to remember that the Federal Reserve is, first of all, a central bank that is chartered by Congress, but it is owned by Wall Street banks. And its ultimate responsibility is really financial stability. We saw what it did when Silicon Valley Bank failed, when Signature Bank failed, and when First Republic had to be merged into some other institution. It started printing money again. It was in the middle of shrinking its balance sheet, $95 billion a month in a quantitative tightening, a sort of reverse quantitative easing. And then it started printing money again, and the stock market soared over the course of the summer. Now things have stabilized, so the Fed's shrinking its balance sheet again, $95 billion per month. Its balance sheet shrink is actually much slower than that of the ECB, which is going much, much faster. You know, I think that when the economy begins to weaken, if it begins to weaken, the Federal Reserve is going to cut interest rates much further and much faster than the forward curve suggests. You know, the previous speaker, I loved his presentation. It was very interesting. He talked about how expectations changed from last May, when people were thinking that the Fed would cut 200 or 300 basis points, and we're actually going to start cutting as recently as September, to now thinking the Fed's going to keep rates higher for longer. Well, those interest rate expectations have changed in that direction, yes, but they are also very, very volatile. And if we have a big drop in the stock market, if we have a significant slowdown in the economy or a dramatic widening of corporate bond spreads, that can change very quickly. And you have to remember, during the last 3 recessions, each time the Fed dropped rates by over 500 basis points. So they could go down a lot. Now, they may be constrained, as you rightly point out, if inflation doesn't come back down. They might not be able to cut 500 basis points, but they could very easily lob 200 or 300 basis points off of interest rates. And we could see a really big re-steepening of the yield curve.
I agree with that.
Yeah. So let's move to
Sure.
other concerns we have in the world. Inflation, obviously, rates. Let's go to the geopolitical arena, Mahmood. And obviously, we wake up last year with the Russia and Ukraine conflict as one of the major concerns in the world, affecting economy, obviously. Now, very recently, the events in Middle East, Israel and Gaza, etc. So what do you think are the implications for the economic stability and the outcome in the future of these specific geopolitical situations, and mainly the impact, obviously, in the European area, which is the most directly affected or linked to these conflicts?
Yeah. Okay. I think you're right to say that when we think about the implications of the Russia-Ukraine war, then Europe is in the center. Europe has the biggest implications. When the war started, I mean, Europe had a very acute problem of finding alternate sources of energy. Okay? Globally, the most important was natural gas, LNG. And if you look at global supply and demand, there were other sources of supply that Europe was able to access. But we should not forget that this was at the cost of other low-income countries not being able to afford liquid natural gas because it came from Qatar, Asia, North Africa, etc. The implication of that is still going on. It's going to take 4 or 5 years for the global supply and demand to get back into balance. I'm talking about liquid natural gas. Okay? Secondly, it has major implications for Europe, because Europe, especially those economies that are more intense in manufacturing, I'm thinking Europe, Germany, okay? Their business model is likely to change. The cost of energy has become more expensive. Their competitiveness vis-a-vis other producers, especially vis-a-vis China and the US, has changed very drastically. Okay? So this has longer-term implications. Previously, when we've seen episodes like this, what you see is large German companies moving production to other economies where they can take advantage of better energy prices, sometimes including lower wages and so on, right? Especially with the car industry in Germany. So you're going to see that kind of trend. That's the implication. That's long-lasting, beyond whenever this conflict subsides, gets resolved in whichever way we might think of, and that's difficult to tell at the moment. In the near term, we may have some risk of gas prices rising again, creating a little bit of a problem for Europe again. There are some discussions on whether Europe should, again, as we come into the winter, cap energy prices for consumers to protect households and so on. So these things are going to reverberate for a little while. And I come back to my central point that when you have a shock like that and a source of cheap energy that is taken away, it doesn't get resolved very quickly. It takes time to find alternate sources and so on. And that process is still going on. Now, I'm not here, as I said earlier, it's too early to tell on what the current Middle East situation implies for the global price of oil. many people, and I suppose implicitly what you see in the market also implicitly assumes that this conflict can be kept localized and rather than have bigger global spillovers.
Hopefully. Talking about geopolitical, thank you, Mahmoud. Talking about geopolitical conflicts or trade wars, the US and China, they are immersed in a very intense conflict. And eventually seems that this is a very unique opportunity for Mexico. One of the main topics that we have discussed throughout this morning in the inauguration, Francisco Cervantes and the rest of the panelists talk about the big opportunity for Mexico regarding nearshoring, Germany moving factories and other economies to better position itself. What do you think about this meaning a booster for the Mexican economy, specifically, Carlos, and how we can capitalize this specifically?
Yeah, I think that it's a paradox because in my opinion, the Mexican economy has been the handling has been very bad in the last few years because of many reasons. And suddenly, paradoxically, we are in front of the best opportunity the country has had for years, right? What we have to do, I think, as a country is concentrated in the public sector, in my view. Because what we need is to be a little bit more similar to the other economies, to the American and the Canadian economy, which we're not at the moment because we have problems in security, infrastructure, logistics, human capital, education, and so on. So I think there is a lot, the list of things to do in order to take full advantage of the opportunity is very large, and it depends crucially on public policy, right, which has to be directed towards these things, right? Now, there is a journalist that once wrote, I liked it very much, about this, saying that nearshoring means that this economy will grow even if we don't want it to grow, right? So
despite ourselves.
Despite, it's not ourselves, but despite the government policies,
exactly.
Right? It's not us, right?
I mean the world.
No, but it's true, because I think, we're concentrated, at least from the government point of view, in having these little fights with the Americans, right? With the GMOs and the energy sector and God knows what. There are some papers or reports from the USTR in which the list of differences between Mexico and the US is just very long, right? So instead of trying to take full advantage of this, right? Instead of doing business and generating the conditions so that these investments flourish. Construction has been already very dynamic in the first half of this year, right? And it seems that in anticipation of all this movement. Right?
Mainly in industrial.
Exactly.
Thank you, Carlos. I don't know if we have any questions from the audience. In case we have one, we can share it. If not, we can go to one final comment from my colleagues here in the panel. Mahmoud, anything that you may add as a final message?
Yeah, I think one thing I'd say is what we're observing in the US, and clearly, like we've all agreed that and even the previous panel, what's happening in US bond markets is having global reverberations, right? I mean, some of the rise in European yields we've seen are to do with, global bond yields. What I'd really like to emphasize is that this is a move, and implicitly I've said real interest rates. This is a move that's not driven by higher expected inflation, okay? And in bond market terminology, what we're seeing in the last 2-3 months is a bear steepening. When you look historically at bear steepenings, A, they're not very frequent. B, they do not last very long. Something gives. Okay. And previously, I think what ERIK was emphasizing, tightening takes time, slowdowns takes time, and so on. So one thing that is likely to give is clearly growth has been very resilient in the US, and it's unlikely to be as resilient going forward. So that's one. And the other is, my worry is if inflation ends up sticky and the Fed has to hold higher for longer, then, as I said earlier, you get the hard landing and you get all the asset price corrections that ERIK was already talking about.
Thank you, Mahmoud. ERIK.
We do one economy that we have not really addressed very much so far at the conference. It's very important is China. I spent 18 days in China in September, and it was very fascinating to see an economy that had been so vibrant suddenly becoming much, much more depressed. You really felt that in Hong Kong, which obviously has its own very special situation, but also in Shanghai and to maybe a lesser extent in Beijing. In China, the housing sector expanded to be nearly 30% of gross domestic product. Now you compare that to the US. The US, when the US had the subprime bubble, or when Spain had its real estate bubble around 2005, 2006, in those two countries, real estate consumed maybe 15 to 20% of GDP. So China was up closer to 30%. You know, this year when China reopened very abruptly in December and January, getting rid of all of their COVID restrictions, everybody expected a huge boom in China. That has not really materialized. Chinese households reduced their savings, whereas in many other countries we increased our savings during the pandemic. So you're seeing very, very slow growth there. And I think that has very negative implications for commodity prices. You know, one thing that's extraordinary to me is when you look at the oil market, oil prices are about the same today as they were 1 year ago, despite the outbreak of conflict in the Middle East, and despite OPEC reducing production by 3.6 million barrels per day. Why? Because Chinese growth is very, very weak. China imports 10 million barrels of oil per day, by far the world's largest importer. What happens to China's growth rate reverberates through industrial metals, through agricultural commodities, and I think weak growth in China could be very, very depressing for commodity prices, which could be potentially bad for other Latin American countries. You know, the commodity exporters like Colombia, Brazil, Chile, but not for Mexico. As we know, Mexico is an industrial economy, very closely linked to the US. So the last time Asia went through a big slowdown in the late 1990s, that was good for the resource importers. It was not good for the resource exporters. So I think looking closely at China's economy will be very interesting for all of us over the next few years.
Thank you, ERIK. Carlos.
Yeah, well, I'll pick it up. ERIK was saying that the Mexican economy is very different from the other Latin American economies, and in that respect, I think the hope for this economy is that there is a soft landing in the U.S. Our industrial production is practically, you know, extremely correlated to the industrial production in the U.S., and so is employment and economic activity, of course. The soft landing, if it happens, it will reduce volatility in financial markets, and that also helps a lot. We've seen it empirically, and I think you're more expert than me on this, but anyway, reduces volatility here in Mexico, and interest rates will be able to fall, and so on. So I just hope that there is a soft landing in the big market we have as neighbor.
Thank you. Mahmoud, ERIK, and Carlos, the time is up already. We, on behalf of Afore, I would like to thank you for being here. Very interesting thoughts and insights. We Afores are long-term investors, so we will go through these cycles with soft, hard, or no landing. But eventually we would always target, as we were mentioning, to maximize the future pensions of our affiliates. So thank you very much, and thank you everybody for being here today.
Thank you.
Thank you.